Silver just crashed $30 in 24 hours. JM Bullion's website, down. The London Bullion Market Association, offline. Every major dealer simultaneously unreachable. And yet, 63 metric tons of gold just changed hands in a single day. The largest delivery demand in recent history. While the price screams sell, the vaults are screaming something else entirely. What you're watching isn't a collapse. It's a trap. And the people setting it are counting on you not understanding the difference. Welcome to your John A.G. If you've been around long enough to remember when a handshake meant something, when people kept their word without contracts, then you understand the value of truth in a world of noise. I'd be grateful if you'd subscribe to this channel, the same way you'd accept a firm handshake from someone you trust. No gimmicks, just strategic economic intelligence. And before we begin, drop a comment below. Tell me where in the world you're watching this from. Because what's happening right now isn't happening in isolation. It's global, and you need to understand why. January 30th, 2026 began like any other trading day, until it didn't. At precisely 2:15 a.m. Eastern Standard Time, silver began falling, fast. Not the usual morning volatility, not a gentle correction, but a vertical drop that defied every conventional market pattern traders had studied for decades. Within 6 hours, the price had collapsed from $120 per ounce to $87, a $33 free fall that vaporized billions in paper wealth before most Americans had finished their morning coffee. On trading screens across the world, red dominated, panic spread, and retail investors watched their positions disintegrate in real time. But something else was happening, something far more significant than the numbers flashing across Bloomberg terminals. At approximately the same moment silver began its descent, JM Bullion's website went dark. For those unfamiliar with the precious metals industry, JM Bullion isn't some small operation. They're one of North America's largest retail dealers, processing millions of dollars in transactions daily, serving hundreds of thousands of customers. Their infrastructure doesn't just fail, not without reason. Yet there it was. Error messages, spinning loading wheels, complete inaccessibility. A curious investor might have assumed technical difficulties, maybe server overload from panicked sellers trying to liquidate positions. That explanation would have been plausible if JM Bullion had been alone, but they weren't. APMEX, down. SD Bullion, unreachable. Money Metals Exchange, offline. Provident Metals, inaccessible. Every major retail precious metals dealer in North America experienced simultaneous system failures. At the exact moment, silver was experiencing its most violent price decline in years. The probability of such coordinated technical failure occurring naturally, without coordination, approaches statistical impossibility. But the retail market disruption was only half the story. Across the Atlantic, in the heart of London's financial district, something even more extraordinary was unfolding. The London Bullion Market Association, the LBMA, the institution that serves as the global hub for wholesale precious metals trading, the organization that facilitates the movement of billions in gold and silver between central banks, refineries, and major financial institutions, went offline, not during a quiet afternoon, not during a maintenance window, but during active Asian trading hours, precisely when institutional demand for physical metal peaks. The LBMA doesn't just go dark. Their systems represent decades of infrastructure development, redundancies upon redundancies, backup systems designed to ensure continuous operation even during crisis conditions. Yet there they were, offline, simultaneously with every major retail dealer, while silver experienced a price crash of historic proportions. To the casual observer, this appeared to be a market in freefall. A bubble bursting, confirmation that precious metals were finally revealing themselves as speculative assets with no fundamental support. The financial media reinforced this narrative immediately. Headlines screamed collapse. Analysts appeared on television explaining why silver's rally had been unsustainable. Opinion pieces declared the precious metals bull market officially over. But experienced traders, those who had witnessed previous suppression events, those who understood the difference between paper markets and physical delivery systems, they recognized something entirely different. They saw a pattern, a familiar pattern, one that had repeated itself at critical moments throughout monetary history. The pattern works like this. When physical delivery demands begin threatening the fractional reserve structure of the futures market, when too many contract holders decide they want actual metal instead of cash settlement, when the ratio of paper claims to physical inventory reaches dangerous levels, the system responds. It responds with price violence, coordinated and sudden, designed to trigger stop-loss orders, to shake out weak hands, to terrorize retail investors into selling their positions. But here was the critical detail that separated informed analysis from panic. The price was falling, yet physical metal was becoming impossible to obtain. Websites were down, not because of selling pressure, but because buying demand had overwhelmed available inventory. The LBMA was offline, not because institutional players were fleeing silver, but because delivery requests were exceeding system capacity. This wasn't a market collapse. It was a supply crisis disguised as a price crash. And buried in the official data from the CME Group, data that wouldn't be widely reported until hours later, was proof that everything the mainstream narrative was claiming was backwards. The delivery notices told a different story entirely, a story of unprecedented physical demand, a story that revealed this crash for exactly what it was, a trap. Most people who watch silver prices don't understand what they're actually watching. They see numbers on a screen, green candles and red candles, percentage changes that trigger emotions, fear when it drops, greed when it rises. But those numbers, those prices flashing across trading platforms, they don't represent physical metal changing hands. They represent promises, contracts, agreements to deliver metal at some future date, or more commonly, agreements to settle those contracts in cash without any metal moving at all. This is the futures market, a paper system built on top of a physical reality, and the relationship between the two reveals everything. On January 30th, 2026, that relationship was being tested in ways that exposed just how fragile the entire structure had become. The day was significant for a specific technical reason. It was First Notice Day for the February gold contract. For those outside the trading world, First Notice Day represents a moment of truth, a decision point where theory meets reality. Here's how it works. When someone buys a futures contract for gold or silver, they're entering an agreement. On one side stands the buyer, on the other stands the seller, and between them lies a promise about metal that will be delivered on a specific date. But as that delivery date approaches, both parties face a choice. They can roll the contract forward, selling their February position and buying an April or June contract, essentially postponing the delivery obligation, staying in the paper game, keeping the promise theoretical, or they can stand, do nothing, and let the contract expire. And by doing nothing, they transform a paper promise into a legal demand for physical metal. The vast majority, perhaps 95% or more, choose to roll. They never intended to take delivery. They were speculating on price movements, trading the promise itself rather than seeking the underlying asset. But that remaining 5%, or 3%, or sometimes even 1%, those who stand for delivery, they're the ones who matter. They're the ones who force the system to prove it actually has the metal it claims to have. And this is where First Notice Day becomes critical, because it's the deadline, the moment when intentions become obligations, when the exchange must publish exactly how many contracts are standing for delivery. Historically, the banks and major short sellers have understood this dynamic perfectly. In the days leading up to First Notice Day, they employ a consistent strategy. They smash the price. The logic is straightforward. If you can create enough fear, enough technical damage on the charts, enough panic among contract holders, many of them will abandon their delivery demands. They'll roll forward, they'll exit their positions, they'll choose the safety of paper over the risk of standing firm. This playbook has worked for decades. Price suppression before delivery dates has reliably reduced physical demands, keeping the fractional reserve system stable, preventing stress on available inventory. But January 30th, 2026 didn't follow the script. Despite silver's $33 collapse, despite the coordinated media narrative declaring the rally over, despite every technical indicator screaming danger, the longs didn't blink. The CME Group's official data released that morning revealed something extraordinary. 20,484 delivery notices for February gold. To understand the magnitude of that number, some mathematics is necessary. Each standard gold futures contract represents 100 ounces. It's the basic unit of measurement in this market. 20,484 contracts multiplied by 100 ounces per contract equals 2,048,400 ounces. Converting ounces to metric tons, the standard for institutional measurement, that equals approximately 63 tons of gold. 63 metric tons, demanded for immediate physical delivery on a single day, for a contract month that isn't even among the year's largest. Historical context makes this figure even more remarkable. Typical February delivery volumes range between 8,000 and 12,000 contracts, sometimes reaching 15,000 during periods of elevated interest. This wasn't elevated interest. This was something categorically different. This was institutional defiance. The price said sell, the chart said run, the media said it's over. And the sophisticated money, the contract holders with resources and research capabilities and understanding of market mechanics, they looked at all that noise and said one thing: deliver the metal. They didn't care about the paper price, they cared about physical possession. They understood what retail investors were missing, that the violence of the price decline wasn't evidence of weakening demand, it was evidence of desperate supply constraints. When paper prices fall while physical delivery demands surge, it reveals a truth the system desperately wants hidden. The emperor has no clothes, or more precisely, the vault has no metal. Not enough metal to satisfy both the paper claims and the physical delivery requests, not without exposing the fractional reserve nature of the entire structure. And so, the infrastructure began failing, not from technical inadequacy, but from strategic necessity. If people can't buy, if dealers can't process orders, if the institutional settlement system goes offline, then delivery demands can be delayed, managed, controlled. The trap wasn't just the price decline, it was everything happening around the price decline. The infrastructure failures, the narrative control, the coordinated response designed to protect a system under siege. But the data didn't lie. 63 tons of gold, demanded, logged, officially recorded. Proof that someone, many someones, understood exactly what was happening and refused to let go. There's an old principle in intelligence analysis. When you want to understand what's really happening, don't listen to what people say. Watch what they do. Words can deceive, narratives can be crafted, explanations can be manufactured. But actions, especially actions taken under pressure, those reveal truth. January 30th showed the world a masterclass in reading actions instead of listening to words. While every financial news outlet was broadcasting the same message, silver crash, investors fleeing, bubble bursting, the physical market was telling a completely opposite story. And that story started with a website that wouldn't load. Bullion had built their reputation over 15 years, starting as a small operation and growing into one of North America's dominant precious metals retailers, processing hundreds of millions in annual transactions, serving a customer base that numbered in the hundreds of thousands. Their technical infrastructure wasn't amateur hour. They had invested heavily in server capacity, redundancy systems, load balancing, all the modern architecture required to handle traffic spikes during volatile market conditions. Volatile markets were their business. They expected surges. They planned for them. Their systems were designed to handle precisely the kind of traffic that a major price move would generate. Yet, within minutes of silver beginning its descent, their website became completely inaccessible. Not slow, not experiencing delays, completely down. Error messages replaced product pages, shopping carts disappeared. Even basic informational sections became unreachable. A technical failure of this magnitude, for a company of this scale, during the exact moment when their services would be most needed, raises immediate questions. But those questions multiply when the failure isn't isolated. AppMex, one of the industry's oldest and largest dealers, experienced identical problems at identical times. Bullion, known for competitive pricing and high volume, their systems collapsed simultaneously. Money Metals Exchange, Provident Metals, Golden State Mint, one after another. Every major retail dealer serving the North American market went dark within the same 30-minute window. The official explanations came quickly. Unprecedented traffic, system overload, technical difficulties due to high volume. But here's where those explanations break down under scrutiny. These companies compete with each other. They use different hosting providers, different content delivery networks, different technical architectures. There is no shared infrastructure that would cause simultaneous failure across independent operations. When servers get overloaded from traffic, they slow down. Pages load gradually, some functions work while others lag. It's a degradation of service, not a complete blackout. And most critically, if this was a selling panic, if retail investors were desperately trying to liquidate their silver holdings, the dealers would have had inventory to sell. Transactions would have processed. The websites might have been slow, but they would have been functional and profitable. Instead, what happened across every dealer was the same pattern: complete inaccessibility, followed hours later by statements about inventory constraints, supplier delays, temporary unavailability of certain products. This wasn't a technical failure caused by too many sellers. This was a strategic restriction caused by too many buyers and not enough metal to sell them. But the retail market disruption, as significant as it was, represented only the visible surface of something much deeper. The real story, the story that confirmed this was coordinated rather than coincidental, was unfolding in London. The London Bullion Market Association operates in a different realm than retail dealers. They're not selling 1-ounce silver eagles to individual investors. They're facilitating transactions between central banks, sovereign wealth funds, major refineries, institutional players moving metal by the ton rather than by the ounce. The LBMA provides the infrastructure for price discovery, settlement, allocation, all the functions that allow the global wholesale market to operate. Their systems handle billions of dollars daily. They're the backbone of international precious metals commerce, and their technical specifications reflect that importance. Multiple redundancies, backup systems in different geographic locations, protocols designed to maintain operation even during major disruptions. This is critical infrastructure built to institutional standards. When the LBMA goes offline, it's not a simple website outage. It's the equivalent of the New York Stock Exchange suddenly going dark during trading hours. It's a systemic event that affects the entire global market structure. And it happened on January 30th, during Asian trading hours, precisely when major institutional buyers in China, India, and the Middle East would be most active. The timing wasn't random. Asian buyers had been among the most aggressive accumulators of physical metal throughout 2025. Their demand had been relentless. Their preference for physical delivery over paper settlement had been consistent, cutting off their access to the primary global settlement system at the exact moment when prices were experiencing historic volatility, effectively removed the most aggressive buyers from the market during the most critical hours. The official LBMA statement referenced technical issues requiring immediate maintenance. But technical issues don't respect market timing. Real infrastructure failures happen randomly. They don't coordinate themselves with price crashes and retail dealer outages. What made this pattern even more revealing was what happened in the physical delivery chain. Reports began emerging from refineries, from vault operators, from logistics companies that move metal between locations. They weren't reporting decreased activity, they were reporting the opposite. Allocation requests were spiking, delivery orders were accelerating, physical movement of metal was increasing even as the paper price was collapsing. One vault operator in Switzerland, speaking on condition of anonymity, described the situation simply, "We've never seen demand like this. Everyone wants physical. Nobody trusts paper anymore." The premium structure confirmed this. Premiums are the amount above spot price that buyers pay for physical metal. In a normal market, when spot prices fall, premiums usually fall too. Less demand means less competition for available supply. But on January 30th, premiums were rising. Some dealers who still had limited inventory were quoting premiums 15 to 20% above spot. In some cases, even higher. This is the signature of a supply crisis, not a demand collapse. When you can't get something, when availability is constrained, when people are competing for limited supply, premiums rise regardless of what the paper price is doing. The final piece of evidence came from the secondary market, from private sales between individuals, from online marketplaces where people buy and sell physical metal directly. Prices there weren't following spot, sellers weren't panicking, buyers weren't backing away. Transactions were occurring at prices substantially above the crashing spot price, proving that people who actually held physical metal understood its value independent of what the futures market was claiming. What emerged from all this evidence, from the dealer outages to the LBMA disruption to the premium spikes to the vault activity, was a clear picture. The infrastructure wasn't failing from weakness. It was being restricted from strength of demand that the system couldn't satisfy without revealing its fundamental fragility. And that revelation, that moment when paper claims exceed physical availability, that's the moment the entire fractional reserve structure faces existential threat. So the infrastructure went dark, not from collapse, but from containment, a strategic retreat disguised as technical difficulty, buying time, managing narrative, controlling access, preventing the run on the bank from becoming visible to everyone watching. But for those paying attention, for those reading the actions instead of the words, the message was unmistakable. History doesn't repeat, but it echoes. And if you listen carefully to those echoes, if you study the patterns that emerge when monetary systems come under stress, you begin to recognize the sound of something breaking. January 30th, 2026 wasn't the first time the precious metals market had experienced coordinated suppression. It wasn't the first time infrastructure had failed at convenient moments. And it wasn't the first time official explanations had diverged sharply from observable reality. But it might have been the loudest echo yet, the clearest signal that the system was approaching a point from which there would be no return. To understand why, we need to look backward, to examine what happened during previous moments when physical delivery demands threatened to expose the gap between paper claims and actual metal. 1980 provides the foundational case study. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, had been accumulating silver for years. Not just futures contracts, but physical metal, tons of it, stored in vaults across multiple jurisdictions. Their strategy was straightforward. Buy silver, take delivery, hold it, and as supply tightened, watch the price rise. By early 1980, they controlled an estimated 100 million ounces. Their buying pressure had driven silver from $6 to over $50 per ounce, and the futures market was facing a genuine delivery crisis. The response from the system was swift and decisive. The COMEX exchange, without warning, changed the rules mid-game. They implemented Silver Rule 7, a regulation that prohibited new long positions, allowing only liquidation selling. The Hunt brothers couldn't buy, they could only sell, and the price collapsed from $50 to below $11 in a matter of days. The official justification was market stability, preventing manipulation, protecting the integrity of the exchange. But the practical effect was protecting short sellers who had sold metal they didn't have, preventing a delivery squeeze that would have exposed the fractional reserve nature of the futures market. The Hunts eventually faced margin calls they couldn't meet. Their empire collapsed, and the message to future buyers was clear. If you threaten the system will change the rules to destroy you. 2011 brought a different flavor of the same pattern. Silver had rallied from $18 to $49 in less than a year. Retail interest was exploding. Coin dealers couldn't keep inventory. Premiums were soaring. And then the CME took action. 5 margin requirement increases in 8 days. Margin is the amount of capital required to hold a futures position. Increasing margin requirements forces traders to either deposit more cash or liquidate their positions. Each increase triggered waves of forced selling. Stop-loss orders cascaded. The price fell from $49 to $32 in 4 days. The official explanation: risk management, protecting the market from excessive speculation. The practical result: breaking the rally, shaking out leveraged longs, relieving delivery pressure on the physical market. 2020 brought perhaps the most dramatic example. The COVID pandemic had disrupted refining operations. Physical silver was difficult to obtain, but futures contracts continued trading normally, creating a massive disconnect between paper and physical markets. The COMEX futures price went to $12, while physical silver eagles were selling for over $30, a premium of more than 150%. The COMEX responded by allowing cash settlement instead of physical delivery, permitting short sellers to pay off their obligations with money rather than metal. This solved their immediate problem, avoiding a delivery default, but it fundamentally broke the connection between the futures market and the physical commodity it supposedly represented. The pattern across all these historical episodes is consistent. When delivery demands threaten available supply, when the ratio of paper claims to physical metal reaches dangerous levels, the system intervenes, not to ensure fair markets, but to ensure system survival. Rules change, margins increase, settlement terms are modified, whatever is necessary to prevent the exposure of the fractional reserve structure. But January 30th, 2026, occurred in a context that made historical playbooks potentially insufficient. The context had shifted in 3 fundamental ways. First, sovereign accumulation had reached unprecedented levels. Central banks had been net buyers of gold every year since 2010, but the pace had accelerated dramatically. China, Russia, India, Turkey, Poland, nations across the political spectrum were converting dollar reserves into physical metal. This wasn't speculation. This was strategic de-dollarization, preparation for a monetary system where gold and silver played a larger role than they had in 50 years. Second, industrial demand had reached a critical inflection point. Silver's role in solar panel production, in electronics manufacturing, in military applications, had created baseline physical demand that couldn't be satisfied by recycling alone. The world needed new silver production, but mining output had been relatively flat, creating a structural deficit that financial manipulation couldn't resolve. Third, the paper-to-physical ratio had reached what many analysts considered terminal levels. Estimates varied, but credible research suggested that for every ounce of physical silver in allocated vaults, there were somewhere between 100 and 500 ounces of paper claims. This meant that if even 2% of paper holders demanded physical delivery simultaneously, the system would face immediate failure. And that's exactly what the February delivery data suggested was beginning to happen. 63 tons of gold demanded on a single day during a non-peak month, despite coordinated price suppression, indicated that sophisticated institutional players had made a calculation. They had decided that physical possession was worth more than paper profits, that the risk of system failure exceeded the risk of short-term price volatility, that the time to exit paper and hold metal was now, not later. This is what made the $87 silver price particularly revealing. It wasn't a market-determined price reflecting genuine supply and demand. It was a strategic price, designed to accomplish specific objectives. First, trigger stop-loss orders among retail and algorithmic traders, creating artificial selling pressure. Second, generate headlines declaring the rally over, discouraging new buying interest. Third, provide an opportunity for institutional accumulation, allowing sophisticated buyers to acquire physical metal at artificially suppressed prices before the discount window closed permanently. The trap worked like this. Retail investors saw $87 and thought crash, and they sold, or they hesitated to buy, or they questioned their entire thesis about precious metals. Institutional buyers saw $87 and thought opportunity. They stood for delivery. They increased allocation requests. They moved aggressively to convert paper exposure to physical holdings. The same price, 2 completely different interpretations, based entirely on understanding the difference between temporary volatility and permanent value. For business owners, for entrepreneurs building real enterprises, for anyone managing capital in an environment of increasing monetary uncertainty, this distinction matters profoundly. The question isn't whether silver should be $90 or $120 next week. The question is whether the monetary system can maintain stability when the gap between paper claims and physical reality becomes too obvious to ignore. The question is whether currencies backed by nothing but government promises can hold value when governments are printing those promises faster than economies are growing. The question is what happens to the price of things that can't be printed, can't be created by central bank policy, can't be inflated away by political necessity, when the system that has suppressed those prices for decades finally loses the ability to maintain that suppression. January 30th wasn't the end of the story. It was the beginning of the end game, the moment when the cost of maintaining the illusion started exceeding the benefit, the moment when the echoes of history stopped being distant warnings and became present reality. The infrastructure failures, the delivery demands, the premium spikes, the vault movements, all of it pointed to one conclusion. This wasn't a trap for silver buyers. It was a trap for anyone still believing the paper price represented actual availability. And the spring was beginning to close.